Hello everybody. In this video I'm going to be doing chapter 3 number 30, and I'll be showing you some journal entries here. So let me start with A. Depreciation on a company's equipment for 2013 is computed to be $18,000. When you're dealing with depreciation, the journal entry is going to be depreciation expense. Will be your debit, because expense, in order to increase an expense you need to debit it, and the corresponding credit will be to an account called accumulated depreciation. I'll use DEP as abbreviation for it, 18,000, and that, everybody, is a contra asset account. Okay. Now the second one, you have the prepaid insurance account had $6,000 debit balance at December 31st, 2013, before adjusting for costs of any expired coverage, and an analysis of the company's insurance policies show that $1,100 of unexpired insurance remains. Okay, so that $1,100 is unexpired insurance. However, the debit balance began with $6,000. So the beginning balance was $6,000, and they had $1,100 remaining. So we used during that period of time $4,900 worth of insurance. So what we need to do is make a journal entry for that, and that journal entry will compose of a debit to the insurance expense, in the amount that we had, $4,900, and a credit to the prepaid insurance account. Now, prepaid insurance is an asset account, and we use part of it, and so that asset account is declining, so that will be a credit. The next one, C, the office supplies account had $700 debit balance on December 31st, 2012, and $3,480 of the office supplies were purchased during the year. As of December 13, physical count showed $298 of office supplies. Now, this goes back to an equation that is, we're going to do the beginning plus purchases minus ending will give you your usage. The beginning here is the 2012 ending balance, which is $3,480. The purchases are I made a mistake. The purchases are $3,480. And let's erase this. And the beginning balance was $700. And the ending balance was $298, which makes the usage $3,882. So we're going to do a journal entry for that, and that is our office supplies expense will be debited $3,882 because it increased. And our office supplies, which is an asset, it decreased because we used those assets. So we're going to credit that asset $3,882. D, 2/3 of the work related to $15,000 of cash received in advance was performed this period. Now, that work, the money for that work was already received. So when we received that money, we would have had, and let me show you this. What we're going to do here is now we're going to debit 2/3 of the revenue that we've already received, or the money we've already received. We're going to recognize that as revenue. So we're going to debit it off of that liability we had, unearned revenue. And 2/3 of 15,000 is 10,000. So $10,000. And we're going to credit our revenue accounts, or let's call it fees earned. So now it's going to go from unearned to earned, and fees earned is a revenue account. And we're going to credit that account $10,000 because the revenue account increased. E, the prepaid insurance account had a $6,800 debit balance at December 31st, 2013, before adjusting the cost of any expired coverage. An analysis of the insurance policy shows that $5,800 of coverage has expired. So the company used $5,800 of insurance. So as you see, just like above here, I'm gonna highlight this one. We are going to do the same thing here for some other prepaid insurance we had. So we're going to debit the insurance expense for the amount that expired, which was $5,800, and we're going to credit the prepaid insurance account $5,800 because now we've used it. Finally, we have wage expense of $3,200 have been incurred but are not paid as of December 31st, 2013. So on December 31st, 2013, we need to expense the wages that have been incurred for the 2013 2013 accounting year. However, it will be paid out in 2014. So what we're going to do, we're going to debit the wages expense account for those wages that were incurred, which is $3,200, and we're going to credit the wages payable account for $3,200. Now, let me go one more step. So, what happens in 2014? So, in 2014, let's say the individual, the company, it pays their employees. Let's say, for instance, there is $1,800 that of wage expense that is incurred in 2014 until they pay off their employees. And that I'm just using $1,800 to simplify the issue. So what would happen is that $1,800 would be expensed as a debit for the 2014, the first 2014 year, And then there would be another debit, and that debit would be for the payable account that was incurred here on December 31st of the 2013 year, right? So that would be $3,200. And then what would happen is you'd have a cash account, cash credit of $5,000. So this equation here, or this transaction here, accounts for the expenses that the company owes for 2014 and what was owed at the end of 2013. And that would be the final transaction for that pay period. That's the end of number 30, and I hope this helps. Have a great day. So we would have had a debit to cash because cash would have increased when we received that money in the amount of $15,000. And we would have debited an account called unearned revenue for $15,000. And this account is a liability. And I'm showing you this initial entry because when we go back to make the adjusting entry,